morning. Great to have you on the show. Richard, what is it that you made of the very hawkish commentary coming in from the Fed last night?
Well, thank you. I have to say I didn't regard it as very hawkish, or maybe there's a bit of hawkish talk. But of course, they actually ended up doing nothing, which is what most people, I think, expected. There was a section of the market that was hoping that rates, or maybe not hoping, but expecting that rates would go up. But I think in general terms, nobody was really expecting a real move or significant move. I mean, clearly the committee is divided, and maybe more divided than the 9-3 actually look at, because you saw quite a lot of what Walsh said in the early part. We've got good growth. We've got inflation above target. You know, clearly it's an issue. Inflation is a big issue. And the only way you can really cure inflation is by crushing demand. And if you crush demand, you push the economy certainly into recession, if not depression. And of course, nobody wants that. So not even the Fed really wants that at the moment, especially with Walsh at the helm, because they're likely to see a barrage of comments from Trump calling them bad people. So I think that really we're in the situation where it's difficult to really look at the Fed as an independent arbiter of where interest rates should be and where they should be controlling inflation. If they did, rates would be much higher than they are now.
Richard, hi, morning. One of the statements that the Fed chair made was that he will ensure that he will bring in price stability. With the fact that Trump is opposing any hike in rates, there's a political resistance which is coming in. How will he bring price stability? What are the tools that he has?
Well, the only tool he really has are interest rates, and that's what the Fed is there for. Of course, there's a lesser tool, which is telling the market with a very serious look on your face that we're going to control price stability. But the bottom line is that the markets will see through that, maybe not this time, but the next time and the time after. And I think, as we all know from our pocketbooks, that inflation seems to be much higher than the kind of 3 or 4% that the official figures are showing us. And what we're seeing too with Walsh is that he's now starting to slice and dice the inflation measures into such a level that you get the lowest level you possibly can. You know, if you take out fuel, if you take out housing, you take out a big chunk of what people actually live on. You know, what people think of inflation is what's going out of their pocket and what's going more out of their pocket. That's really all they're really worried at. And I think the market will see that through that sooner or later. And the bond vigilantes will hit the bond market if they think that the Fed is really just using talk. So the only real tool is to put rates up.
Richard, what is it that you're making of this chip meltdown, which has begun to take place, led, of course, by some of the major South Korean earnings and extremely highly leveraged trades there?
Well, yeah, the leverage trades doesn't help, but let's face it, we've seen up to 50% fall in some of these share prices, but that's on 100 and something percent rise to the top. So I think, you know, the history books, I mean, we all talk about in cricket, you know, it's really what the scorecard says at the end of the day. You know, the scorecard will say at the end of the day, these stocks are still 50% up or something like that. Yes, there was a big spike that spiked up. They may well come off a little bit because it's been a great deal of hype about chip stocks. But let's just wait until close of play before we make too big calls on what these stocks are really doing.
And how do you look at other assets? Because if inflation is going to head up, you're seeing dollar under pressure and then gold rallying as well.
Well, I have a fairly bearish view creeping in about the markets. You know, what we're seeing is quite significant flattening off, weakening momentum. Bond yields are up. We know inflation is going up in many areas, but not really being reflected. We've got war, terrorism. We've got competition on chips coming out of China. We've got European possible resistance to Chinese exports. We've got a Trump and indeed Putin looking increasingly erratic. All of these things are quite strong bear factors, I think, for the autumn, for the fall coming up. So I think investors probably should be quite cautious. I wouldn't be a big seller at the moment, but I'd certainly be looking at how leveraged I am, how geared I am to the markets, and maybe it's time just to take a little bit of that energy out.
Richard, the other aspect is the kind of what's happening in Japan. You have the yen, which is at 163.70. There too, we are seeing the 10-year yields inching up. Intervention is expected. You have the Bank of Japan, meet as well this week. What is your assessment? What's happening there with respect to yields and the way the currency is depreciating?
Well, Japan is always a riddle wrapped in an enigma, to sort of misquote Churchill. I think we're in a situation where, to a certain extent, Prime Minister Takahashi is a fresh breath of air. But on the other hand, some of her policies, which are, well, let's borrow to get out of this situation, are not really helping. You know, they are likely to lead to inflation, even in Japan, which isn't really used to it. They're certainly likely to lead to weakness in the yen. And although honeymoon periods do last a certain period of time, I think she's rapidly running to the end of hers. So I think her policy mix is going to have to change. Otherwise, we'll see continued depreciation of the yen.
Richard, great to chat with you this morning. Thank you so much for your time.
Thank you.